Ladies and gentlemen, welcome to this special interview. Today we have a returning guest to the show, Michael Pento of Pento Portfolio Strategies, located at pentoport.com. And I got to tell you, not many people out there are successful money managers in these conditions. But you know what? Michael's not really a perma bear in anything. He's not really a perma bull in anything. He just kind of sees it like it is, calls it like it is, and capitalizes on it. He's also the author of The Coming Bond Market Collapse, and we're delighted to be able to pick his brain today. Michael, I'd like to thank you for joining us again on Silver Doctors.
Thanks for having me back, Paul.
Michael, this is an exciting day in the stock market. We're looking here down 850 points as we speak. President Trump came out with a tweet saying, do you notice that anytime the fake news suppression polls are put out, the stock market goes down? We're going to win. But the poll that was put out saying Biden has a small lead, that's been known through all this time. So looking at the stock market today, was this really just the most epic suckers rally of all time? Are we in a new bull market? What are you seeing in the stock market, Michael?
First of all, I try to be apolitical. I'm a libertarian, as most people know. I just think it's disgusting that any president would just, hitch his star to the stock market. I mean, do we really need to have a tweet from any president every day about how the stock market is doing? Like yesterday, he tweeted, "Thank me. Aren't you glad," paraphrasing, "aren't you glad you have me as your president? Thank you, Mr. Trump, for a great stock market." Well, today, the stock market is down, some healthy profit taking. Nothing in my model says it's really a start of a cyclical bear market yet. But one is coming for sure, like we've never seen before. It's just maybe not today is the start of it. And today, as you say, he's blaming the polls for, but listen, newsflash to Mr. Trump: stock markets go up, stock markets go down in a normal economy, one that's not manipulated. This one's been the most manipulated stock market we ever seen in our lives. So before today, it was. Being the market cap of equities as a percentage of GDP was 185%. And why? What happened yesterday? I'll tell you why the stock market went up yesterday is because the CDC came out and said, here's the date, November 1st, we're going to have a vaccine. So get ready, states, to distribute this vaccine. Crazy. Vaccines, by the way, Paul, usually take years to develop. This one is being developed at hyper warp speed and is going to be put out to the public, right before election day. So, this is a scary time. I personally, I would like to know, I like to meet the people that are actually going to be taking this vaccine that has been completely, I don't care what anybody says. It's a new technology for a new novel virus. And to have the idea we're going to push this out ahead of an election is ridiculous beyond, it's ineffable how ridiculous as that sounds. So I don't know how many people are going to take it, how effective it's going to be, but certainly that's one of the reasons why the stock market went up so much yesterday. And of course, the real reason why the stock market is going up to the moon is because Mr. Powell said interest rates aren't going to ever go up in our lifetimes for many, many, many years. They're not going to rise until he pushes core PCE inflation above 2.5%. The way that, if the Fed measures core PCE inflation at 2.5% and keeps it there for many, many years, as many years as it was below 2.5%, then real inflation is going to be double digits. So hide it, get under the bed and hide in the closet.
Mm-hmm. Yes, very interesting. And, you're referring to the virtual Jackson Hole Economic Symposium from last Thursday when he came out with the speech and the supposed game changer. So let's stick on this inflation topic for a little bit here, Michael, because, it's interesting because it almost seems like people got a little bit excited. Oh, the yield on the 10-year note popped about 0.7%. This inflation thing is actually true or not. And it's right back down again today, going back to that 0.6%. So, it's also possible that they could be the buyer of first resort, the buyer of last resort. My point is, I don't see the bond market ending gracefully. I don't see interest rates going up gracefully. It seems like it's either suppress or die. Wow. Am I thinking about that anyway clearly at all, Michael?
Well, other than me, you're probably the only person I have ever heard say that. Maybe there's a handful of other people, but you are incredibly insightful for making that observation. I made that observation in 2012 when I wrote the book, The Coming Bond Market Collapse. So interest rates on the 10-year spiked to 0.7%. They went down to 0.6% in a matter of a few days. I mean, maybe I'm on an island here. I'm not one of the ones screaming hyperinflation, here it comes, because Jerome Powell and the rest of his ilk at the Federal Reserve has been unable to achieve 2% on core PCE 7 out of the last 12 years. So 58% of the time, the Fed has been unable to reach 2%. So now, just by saying that you want it to go to 2, you want core PCE inflation to go to 2.5%. That doesn't, what are you doing differently? You haven't changed monetary policy in the last few weeks. I mean, you changed monetary policy in March, but not in the last few weeks. The Fed's balance sheet, by the way, has actually plateaued at around 7 trillion. And there hasn't been any big fiscal stimulus package for many, many months. So how do you get higher inflation? I'll tell the Fed how to get higher inflation if they really want to know, if they don't know. It's not by too many people working. Oh my God, God forbid, I got a job and now it's hyperinflation. It's not quite how inflation works, okay? So if you want consumer inflation to catch up with the asinine level of stock market inflation, you need to have the fiscal, I call it the unholy union of fiscal and monetary policy. So you need the Fed increasing its credit to banks. Okay, that's the balance sheet growth. You need that. But you also need them to monetize treasury debt that's being directly used for helicopter money, universal basic income, PPP loans or grants. So you're getting the money not just to banks who just keep it, they keep it in the bank, or they maybe buy some assets with it and it stays around Wall Street. You need, for consumer price inflation to rise, you need inflation and money supply to go to people. So you need the broader monetary aggregates to increase. How do you do that? I just said universal basic income and helicopter money. So we don't have a fiscal package passed. The PPP loans or slash grants are exhausted. And your $1,000 check has been spent. The enhanced unemployment, which was, you were getting $1,000 a week under enhanced unemployment. Now you're back down to, in some cases, small cases, 600 or maybe 300. So you had a huge pay cut. So where's the inflation going to come from? I believe, and so far I've been right. I predicted earlier this year that we would have a period of deflation. Got that right. Then I predicted a period of stagflation because of what the Fed and the Treasury did. Got that right. And now I think that we're in a period of disinflation. And I'm hopefully going to be right there. And you're going to have that until you see a massive fiscal package passed that will give, support to a consumer because, and I'm not, by the way, I'm not advocating that one passed. You asked me how we're going to get hyperinflation or stagflation. Again, you need another massive stimulus package, fiscal stimulus that's monetized by the Fed. I don't think that's coming. The earliest that's coming is late September. That's right. But, that's just late September is a little more than a month away from the election. I don't see Nancy Pelosi, Speaker of the House, giving President Trump a massive stimulus package right before the election. So either the Republicans are going to have to assent to a $3 trillion CARES Act, HEROES Act, or there's going to be nothing done.
Mm-hmm. That's very interesting because, I was thinking that maybe it's going to come from pressure on corporate America because, just a few weeks ago, it was American Airlines and they're saying, oh, we got to get rid of 40,000 people, 19,000 involuntarily if we don't get another bailout. Then 2 weeks ago, it was also Delta saying, oh, we're going to have to get rid of over 2,500 pilots. And then just yesterday, it was United and they came out throwing 16,000 people might be up for layoffs. So, it seems like there could be some pressure there, but on the back end, it's also possible that the Fed could come in and, maybe fund some corporate bonds to keep them afloat in the meantime, because I'm seeing that point about the Nancy Pelosi and coming so close to election. So those add some interesting dynamics there. In addition to that, the other thing that I'm looking at when it comes to the bailouts is the Gallup poll, where 7 out of 10 people want those payments again in the United States. So
sure,
there's a lot of dynamics there.
Well, bread circuses, are you going to turn down, free money? I mean, the richest of us didn't see any money at all, not one dime. But if you made less than $198,000 a year as a family, you got a lot of money. $1,000 per adult, $500 for kids, and I believe that the Democrats wanted to go even further. So Kamala Harris, I think she wanted, the way I figured out, $120,000 a year in universal basic income. That's how it adds up. $120,000 a year. But I apologize. I didn't really fully answer because I was rambling a little bit. Your question, your insightful insight as to what's going to happen with the bond market. Paul, this is what we have. We have an insolvent government. In fact, the whole developed world is insolvent. And the only way the solvency is kept alive, kept viable, is by interest rate suppression. Massive. We have $15 trillion of negative yielding sovereign debt around the world. So how is the United States, which is now 130-something% debt to GDP on the national level, how is the United States solvent with $4 trillion annual deficits, which are 20% of GDP? How are corporations that are loaded with zombie corporations and zombie debt, how are they not defaulting? Well, they are defaulting, but how are they not even defaulting in greater numbers? Because borrowing costs have been massively falsified by the Federal Reserve. So you have and what happens when you falsify borrowing costs? You borrow more money. So corporate, business debt was already 80% of GDP going into the Wuhan virus outbreak, and now it's probably 90, 100% of GDP. I don't know the exact figure off the top of my head because I have so many figures in there. But I can tell you this: if you could float a high yield bond, a high yield junk bond for 2.8%, okay, Aluminum Can Corporation Bull is floating high yield junk debt at primary issuance at below 3%. This is why you're so correct. Because whenever we get inflation, this is it. You said that how can interest rates rise gracefully back to where they were, historically, normalized rate? Well, by the way, we tried that in 2019. Didn't work out so well. Remember, we brought interest rates on the Fed funds rate to 2.5%, and the world fell apart. Well, imagine when you get inflation. So let's just imagine that Mr. Powell and his merry band of monkey money printers gets 2.5% on core PCE inflation. And that means that the real inflation rate is closer to double digits. And that means a 10-year note starts running not from 6%, where it should be, historically speaking, but it goes from 0.6%, 1, 2, 3%. Now, Mr. Powell, if he's still around, is going to have a choice. Because inflation, then, he gets his inflation. It's been inculcated. That's what inflation is when you inculcate to the market that your currency is going to be depreciated. That's the real progenitor of inflation. That's it, okay? People losing faith in the purchasing power of a dollar or whatever current currency you're using. So he gets his inflation. He gets his crazy inflation rate. The street, the private market says, forget it. I'm out of 10-year treasury. I'm out of the long end, 30-year bonds. Start selling them. Interest rates start rising. Now, it's at that point. So what are two things the Fed can do? The Fed can either say, I'm going to have to buy or print more money, create more inflation to try to push down that yield, which isn't going to work. You can't placate a market that's worried about inflation by creating more inflation. Or what he could do is say, you know what, I'm going to fight inflation now. I'm going to be like Paul Volcker and start raising interest rates. Well, when you raise rates, when the market says suppose inflation's 8, 9, 10%, you're going to have to raise rates a lot more than zero. You're off from zero. You're raising rates from zero and you're stopping QE. So the market's going to say, oh boy, here comes the Fed. I got to get out of bonds, right? So either way, the bond market doesn't go up gracefully. The yields don't go up gracefully in any scenario once you get inflation. And that's what I'm here modeling every day. I'm waiting for that. I won't miss it. I'm waiting for that inflation to start to become start to run intractable. When that happens, it's going to be a wipeout, Paul, like we've never seen before. Because you think about Paul Volcker, when he raised rates in the late 70s, or you think about the 1987 crash, the total market cap of equities as a percentage of GDP was 40%, 60%, somewhere around that neighborhood. But when the stock market is 185% of the underlying economy, it is the economy. I mean, the stock market crashes and the economy will implode like we've never seen before. So rising interest rates are going to implode stocks. Inflation will be the progenitor for that, and it's lights out for the stock market. It's lights out for the economy for a long time.
Now, switching over here to real estate, Michael, I'd like to get your thoughts on real estate. I just want to mention a few things here really quickly. 2 days ago, Steve Mnuchin said in his testimony before Congress, this is nothing close to what was the mortgage and housing crisis that we had during the recession. But then yesterday, the CDC comes out and they're like, well, you can't evict any renters through the end of 2020. So that doesn't really jive there. That's one point. The other point is we're seeing massive spikes in the price of lumber. That's point number 2. And these are all kind of not really related, but sort of. Point number 3 is we're also seeing the phenomenon of moving from urban areas that may be experiencing civil unrest, looting, and riots to the suburbs and to the countryside. So it seems just there's so many dynamics going on in real estate right now. What are you looking at in real estate, and what are your thoughts on the real estate market in general right now, Michael?
So I think Mnuchin is correct when he says that what he means to say is the nucleus of this bubble isn't real estate. It's part of the bubble. It's definitely in a massive bubble, but it's not the nucleus. The nucleus of this bubble is corporate debt. It's the corporate debt market. That's the nucleus. But are real estate prices in a bubble? Absolutely. There's no doubt about it. If you look at the home price to income ratio, it's still way out of whack, historically speaking. So there is a bubble. It's an echo bubble. But why aren't there more, people being evicted? Well, first of all, the government borrowed $3 trillion and handed it out to people in the form of helicopter money. So, and then the government said, by the way, here's your money that you would have made if you didn't become unemployed. 29. Paul, there's still. It's mind-boggling. I was just, hearing what CNBS said about their version. Better than expected. Initial jobless claim. Blah, blah, blah. Well, better than expected because they didn't tell you that. Well, I didn't hear it. Maybe they did, but I didn't hear them say the Department of Labor changed the way they do their seasonal adjustments. So you can't compare this week's initial claims to last week's initial claims. Let's compare the unadjusted data. Oh, this week was higher than last week's. Oh, and by the way, if you add in PUA, pandemic unemployment assistance, the number spiked by 2 million people. There's 29 million people collecting unemployment. But you told those people that you're going to give them not only supplant their income, but you're going to give them more than they made by being employed in most cases. And then you told them, oh, by the way, don't worry about making your credit card payment, your student loan payment, your mortgage payment, your car payment. Don't worry about that. Don't worry about that for a while. And then you wonder why people haven't been evicted and why the home prices have stayed afloat. Oh, by the way, I was talking to a realtor as I'm buying some property in Florida. I was talking to a realtor who he sent me some information that almost all of the purchases in the Naples area are cash. Well, who do you think is buying real estate? So it's called the evisceration of the middle class and lower class. So these are renters. Wonder why renters can't afford homes, because private equity firms are bidding up real estate prices by paying cash, borrowing money from the bank at almost nothing, buying up huge tracts of real estate, sending prices through the roof. Okay, and then you wonder why is there so much inequality in this country? Why is this? What? Well, it's because we're falsifying every market on the planet. That's why.
Mm-hmm. Now, Michael, crazy times, nothing is surprising in 2020. So I guess the question is, as we move into fall here, what is the one thing that's on your radar the most? Is it the election? Is it what's unfolding on the streets of America? Is it the stock market?
So that's a question that probably take me an hour to answer. So I'm watching the virus, of course. I'm watching for when these vaccines. By the way, Paul, everybody who has ever had a tangential relationship with a medical firm now has a vaccine. I mean, there's like a 10 trillion vaccines that are coming out by the fall. Okay, so the vaccine. So I want to see how soon does the vaccine come out? How effective is it going to be? How fast is it distributed? How many people end up taking it? So I'm watching that very, very closely. Of course, all eyes are on the election. I want to see what happens with the election. Does the White House turn Democrat? I think at this juncture, a divided government, which is normally good for the stock market, is really bad for the stock market this time, because you're living in Alice in Wonderland so long with the fiscal and monetary stimulus that if you don't get the parties to agree on more fiscal and monetary stimulus, then you're going to have a big problem, a huge fiscal cliff in 2021. I'm very much myopically focused on continuing unemployment claims. I want to see that number, which was like, 1 or 2 million people before the pandemic. It's now 29 million and going up. It's going the wrong way. So I'm myopically focused on that. So you got stimulus, you got the election, and you got the virus. Those are the three things. I can't pick one, which is, they're all critically important for how I model the IDEC model, which I created, the inflation, deflation, economic cycle model.
Indeed. And in a few months here in the winter, we'll like to see what's on your radar the most then. And in addition, my understanding is it's called like the inflation, deflation, growth strategy. And I suppose it's
the inflation, deflation, and economic cycle model.
Okay.
So basically, I have 20 components, 10 for inflation, deflation, that dynamic, 10 for growth, recession dynamic. And if you know where the economy is cyclically speaking, are we growing or are we recessing? Are we inflating or are we in disinflation or deflation? If you know that, where should you invest? Where's the best place? What style factors? What sectors should I own? And it's a big difference. If you own, give me one example. So we've been heavily weighted towards utilities and bonds in our portfolio. Pretty amazing for someone who wrote a book called The Coming Bond Market Collapse. But when you have disinflation or deflation, that's where people run to bonds. If you have slow growth, disinflation, deflation, people go to bonds, utilities. Compare those returns with those who are invested in value and banks in a world of a flattening yield curve. So the outperformance is outstanding, the difference between the two. That's what I'm talking about when it comes to inflation, deflation, economic cycle. By the way, you want to own gold in sector 1 and 2 of my portfolio of the investment spectrum, but you don't want to own gold when growth and inflation are accelerating. You don't want in other words, when real interest rates are rising, you don't want to own gold. So you have to watch these things and model the changes in fiscal and monetary policy. Am I perfect? No, I make plenty of mistakes. But it's better than saying, well, the calendar says, it's a bit, sell in May and go away. That kind of stuff doesn't help you. Or, how I wake up every morning and say how I feel, or read headlines, say, well, if you, headline gazing. That's not how you invest. That's how you not. That is not a recipe for successful investing.
Yeah, if you were waiting on summer doldrums this summer for gold and silver, you missed out on that one big time. So best way for people to contact your company if they're interested in your strategy, Michael?
So it's pentoport.com, P-O-R-T.com. The phone number for the office is 732-213-1295. And my email is mpento@pentoport.com.
Michael Pento, I'd like to thank you for joining us again on Silver Doctors.
Thanks for having me back, Paul.